So shall we get started? Jonathan
Okay.
has, Jonathan has 8 minutes to talk.
Yeah, okay. So good morning or afternoon, wherever in the world you may be. Rafet and I are delighted to welcome you all to the conference associated with the Research Handbook on Financial Markets. We had high hopes for this handbook when we started it, and the draft chapters that we've read exceeded those high expectations. So thanks to all of you, this handbook is shaping up to be an up-to-date reference book on a world with rapid changes in financial markets, and it will be useful to practitioners and academics alike, we hope. So some logistics, first of all. Each session is 30 minutes long. The presentation is 15 minutes. The discussion is 10 minutes, and the Q&A is 5 minutes. To share your slides, you just press the familiar green button, and the panelists should all be empowered to do this. It's amazing to think that just over a year ago, none of us had ever heard of Zoom. When it comes to questions, panelists can just unmute yourselves and ask a question. Other audience members should send the question in the chat to me or Rafet, and we will try to ask as many questions as possible. We're going to hold off on answers till the end, and if we run out of time, there's always the chat facility to answer questions. It's very important to keep things running on time, and so Rafet and I will be ruthless timekeepers. Before we get going, Rafet and I would like to thank the CEPR and Sena Turem and Mahmoud Ipek for their hard work in making this conference possible. There's a lot of work behind the scenes in putting a conference together, and we couldn't have done this without Sena and Mahmoud. It's great to see a lot of familiar faces here this morning. Our first talk coming up in just a few minutes is by Kosuke Aoki, who's going to tell us about the Bank of Japan balance sheet. For Kosuke, it is nearly 11 o'clock at night. So thank you very much for staying up late to participate in this conference. And maybe we can just start a couple of minutes early.
Okay, but before I start, can you see my screen?
Yes, we can.
Okay, very good.
So the floor is yours, Kosuke.
Okay, thank you. So first of all, thank you very much for inviting me to this handbook. And so I'm going to explain the following things in my chapter. Okay, so first I'm going to explain the Japanese economy and the BOJ's policy since the late 80s. And I focus my attention on the developments in the BOJ balance sheet. Okay. And then in the second part of my chapter, I review empirical studies of the balance sheet policy. Okay. So issues I focus on is how the balance sheet policies contribute to expectations management, and also purchases of ETF, the BOJ buy stocks actually, and those effects, and effects of massive purchases of JGB, and effects on bank lending. And finally, I will talk about the overall effects on macroeconomy, and finally, monetary fiscal interaction through the balance sheet policy. Okay, so those are what I'm going to write in this chapter. So the main messages of this chapter is, as many of you may know, the BOJ has used a balance sheet policy for more than 20 years. And the balance sheet size has been quite large compared with the other central banks, but its size expanded significantly since 2013. And the JGB is the dominant asset the BOJ buys. And regarding policy effects, there are strong evidences for effects on asset prices, like long-term interest rates, stock prices, and exchange rates. And there are weaker evidences for policy to contribute to anchoring inflation expectations. And there are many positive evidences on the positive effects on bank lending, but the overall effects on macroeconomy are found to be modest. So those are the main messages in this chapter. Okay. So then let me briefly talk about the Japanese economy and evolution of BOJ policy. Okay. So this is the balance sheet size of the BOJ relative to GDP. And for comparison, I also plot the size of the balance sheet of ECB and the Federal Reserve Board. And you can see, so blue line is the Bank of Japan. And you can see that from 2000, the BOJ's balance sheet size is much larger than the other central banks because as I will show you, Japanese economy was in trouble much earlier than the rest of the world. Okay. So then, but after 2013, now you can see a massive increase in the size of the balance sheet of the BOJ. And now it's almost 130% of national GDP in Japan. Okay. And behind these developments, as you may know, many of you know that Japanese is suffering from low inflation. And this is not just a recent phenomena or problem. And so this line is 2% inflation target. So blue one is again Japan. And Japanese inflation rate is below 2% for almost 30 years. So Japanese get used to low inflation quite a lot. Okay. So behind that, the reason for why Japanese inflation has been low for a long time is because we experienced boom and bust earlier than the United States. So this is the stock price that peaked in the late 1980s and huge collapsed in the early 90s. And similar observations are made in land prices as well. And as a result, the BOJ faced the zero lower bound on the short-term nominal interest rates much earlier than the other central banks. So the Japanese short-term interest rates are subject to the effective lower bound for almost 25 years. So later on, I'm going to explain the sequence of policies, but this is an overview of the balance sheet composition. So this is the zero, and the positive part represents asset side of the balance sheet of the Bank of Japan, and the negative area is the liabilities. And let me focus on, and this is from 2000 to the most recent periods. Okay. And as you can see, on the asset side, so blue one is the JGB. So Japan and BOJ expanded its balance sheet size by mainly buying JGBs. But a unique feature of the BOJ is probably this area. So this orange one is basically equities or stocks. So they buy ETF. Okay. And recently, orange one also expanded. So this is responses to COVID-19. So the BOJ is also helping corporate finance, like similarly to other central banks. Okay. And so now, I am going to explain three major QEs of the BOJ. The first one is from 2001 to 2006. So this is what we call first QE. So here, the BOJ changed its operation target from interest rate to the current account balance for the first time. And but I think interesting observation is at that time, they didn't increase its balance sheet size by buying long-term JGBs, but they mainly bought short-term JGBs. And after the global financial crisis, the BOJ also, again, adopted quantitative easing, which was called comprehensive easing. So that was from 2010 to just before the introduction of QQE. But unique feature of this policy was to create an asset purchase program. So this is the starting point of the BOJ buying many kinds of assets, not only JGB, but they bought commercial papers and corporate bonds. And as I will show you, so they bought ETF and JREIT. So this is a real estate investment trust. Okay. And size increased again and again. Okay. And I think probably this is the most of you know this because this is famous. So this is a so-called QQE, quantitative and qualitative easing after 2013. Okay, and this sentence is became famous. So the BOJ says that in order to achieve 2% inflation, the BOJ will double the monetary base and JGB holdings in 2 years. And again, they switched to monetary base control from interest rate control. And the difference from the previous policy regimes was they decided to buy massive amount of long-term JGBs. And also, they increased their purchases of ETF and JREIT. But unfortunately, inflation didn't reach to 2%. So therefore, the BOJ introduced many subsequent enhancements of the QQE. So in 2016, they introduced negative interest rates and yield curve control in 2016. So there they explicitly target the 10-year yield at 10% by buying JGBs. Okay. And like many other central banks, after the outbreak of COVID-19, they helped corporate finance. So that was the first part of my chapter. And then I reviewed some of the empirical studies of the effectiveness of balance sheet policies. Okay. And first, expectations management. Okay. So let me briefly summarize the main results. So the literature finds that forward guidance on long-term interest rate worked. So there are many strong and many evidences for that. And also there are strong evidences that stock prices and exchange rate reacted. But turning to the inflation expectations, so even though the bank announced the inflation target, or the bank says that balance sheet size is going to expand, inflation expectations did not react too much. And also the QQE aimed at changing perceptions of monetary policy by the public people, but there's little evidence that the introduction of QQE changes people's perception about monetary policy. And so ETF. So this chart shows you the BOJ's share in the ETF market. So they started buying ETF in 2010, and the peak share was 70%. So now it's a very big player in the ETF markets. And so here's a summary of the empirical results. So there are many evidences that the BOJ's purchases affected stock prices. And also effects are state contingent. So the literature finds that effects are stronger during market downturns, or the BOJ's purchase volume is large. So in that sense, this is evidences that capital constraint channel may be working in this market. And there are some evidences of market distortion by this policy because the BOJ is buying a Nikkei 225, which is a bit not really representative of the market capitalization. And regarding on the effects on investment, there's only a little literature, and literature says that there's a weak evidence on the investment. And JGB. Okay, so now this picture is quite interesting, I think. So black line is the supply of JGB to the market, excluding the BOJ's holding. And this is a total supply of JGB. So now you can see that the net supply of JGB to the market shrinked after the BOJ started massive amount of JGBs. And the paper, so literature finds that these massive purchases decreased long-term interest rates. And this is an evidence of this scarcity channel working in the JGB market. And effects on bank lending. So the literature investigates the effects of increases in BOJ current account balance or the declines in long-term interest rates on bank lending. And overall, I think that the literature finds that the BOJ's policy contributes to the increase in bank loans. And effects on macroeconomy. So there are many papers on this field, and many of them use time series technique. And overall, many papers find positive effects, but the effects on inflation are weak and uncertain. That's a kind of common finding. And I think interesting finding is a study by Hayashi and Koida. So they examine the effects of exit from QE. And interestingly, they find that exit from QE has an expansionary effect. Okay. And the cross-country comparison, there are some papers, and I think papers tend to find that compared with the effects of the other central banks, BOJ's policy effects are somewhat weaker. And in the interest of time, let me briefly skip, let me skip this one. So this is a counterfactual simulation by using a macroeconomic model. Okay. But I want to spend more time on this slide, fiscal implication, because as I showed you, the BOJ has bought massive amount of JGBs, and the balance sheet size is huge. And the Fujiki and Tomura simulates what would happen to the bank's BOJ's profit if they exited from this QE. And their simulation is the following. Suppose inflation reached to 2% in 2018. Unfortunately, it didn't become true. But the bank increased the rate gradually towards 2.75%. So if this happened, they simulate that the BOJ would run losses for 15 years, and the maximum loss would reach 1.4% of GDP. And this is not due to capital losses of long-term JGBs, but this is coming from maturity mismatch, because the bank is holding long-term JGBs, but the current account balance is short or quite liquid. Okay. And the directions for future research. So after reviewing the literature, I find that there are not many papers on the effects of liquidity provisions, and also effects of J-REIT purchases. Those are missing. And there's still, I think, important issue. Fiscal implication is still an important issue. And finally, so understanding low inflation is still an important puzzling question. Okay, I think I spent 15 minutes. Thank you very much.
Thank you very much, Kosuke. And the discussion is going to be by Oreste Tristani at the ECB.
Hello, good morning, good afternoon, good evening to all of you. Can you please confirm, Jonathan, can you hear me well? And do you see the slides in full screen?
I hear you, and yes, I see the slides in full screen. Thank you.
Perfect, thank you very much. Okay, so let me also start by thanking Jonathan and Refet for inviting me to take part in this project. And then jump to Kosuke's chapter. So I think the chapter, the topic, the task here is to review the Japanese experience. And as we all know, the Bank of Japan has faced the lower bound on its policy rate for much earlier, for much longer than many other central banks did. It has introduced these different kinds of unconventional monetary policy measures ever since the late 90s. So Japan is the place to ask the ultimate question: do large-scale asset purchases work, and are they effective in increasing inflation and output? And this is exactly where Kosuke starts, and so the main chapter in the main question, sorry, in the chapter, which I think is completely fitting. So the chapter is essentially two sections. First, it provides a brief but effective overview of the various measures adopted by the Bank of Japan and measures that had an impact on the evolution of its balance sheet. And then it moves on to discuss there, to review the literature that assesses the empirical effectiveness of all these measures. So I want to emphasize three main points in my discussion. So first, I want to zoom in on one dimension, which I think makes the Japanese experience particularly interesting, and which will also be relevant for my comments later. And then I will highlight what I particularly like in the chapter, and I finish off with a couple of suggestions on aspects which maybe could be slightly expanded or organized slightly differently. Okay, so why is Japan?
Oreste, we can't actually see your slides. We're seeing only the, I think you need to share you're sharing the wrong thing.
Uh-huh. I thought that Jonathan was, okay.
I see the title slide.
All we see is the title slide.
I'm on the title slide, sorry. That's correct, that's correct.
Oh.
So, can you see the transition?
Yeah,
very good, very good. Okay, this is
opinions expressed. Yeah.
Usual disclaimer. Okay, so why is Japan so interesting? And so to motivate, let me show again a different version of what of the balance sheet of the Bank of Japan. This is similar figure to the one that Kozuke just showed. And I also include the euro system as a benchmark. The Bank of Japan balance sheet is in orange, and the euro system is in blue. And as Kozuke emphasized, the Bank of Japan started increasing the size of the balance sheet already in the late 90s, and you see that in the early 2000s it's already about 20%, over 20% of GDP. I should say both measures are as a share of GDP. But you really see this stark acceleration as of 2013 with the introduction of this QQE policy. And I think that this is, the important aspect here is that there was a really widespread consensus in the profession that low inflation in Japan before QQE could largely be interpreted as a monetary policy mistake. And one reason was that, as Kozuke also emphasized, the first QE in the early 2000s was really focused on purchases of short-term government bonds. And this implies that it was very close to the sort of pure form of QE that we know from textbooks to be irrelevant in theory, because short-term government bonds are almost perfectly substitutable for central bank reserves. But things change after QQE. And so, there's actually, I find an interesting paper by Mark Gertler commenting on this experience. And Mark Gertler highlights that, there's many challenges for the profession in general, for macroeconomics in interpreting the Japanese experience. And let me read, it is no longer possible to blame the stagnation in Japan on mismanagement of monetary policy. Since the spring of 2013, through the introduction of QQE, the Bank of Japan has implemented what many view as a state-of-the-art policy program. Okay, so, a corollary of this conclusion is that the experience of Japan until 2012 and as of 2013 are interesting for sort of slightly different reasons. To oversimplify, the earlier years are interesting mainly as an example of, what can go wrong in monetary policy if central banks don't play by the book. And from 2013, instead, what is interesting is that, this is interesting, the experience is interesting because it really can help us to finish writing the book, because we don't really have a fully specified reference framework for on what central bank can do to effectively get out of a liquidity trap. Okay, so again, I will get back to this, but having argued this, let me now talk about what I find especially interesting in Kozuke's chapter. And I should say here, should confess that my comments are also inspired by the sort of joint reading of this chapter, the chapter on the euro system, and the chapter on the central bank, on the balance sheet of the Federal Reserve. And it's interesting how this, we have slightly different perspective on these three on a relatively narrow topic. So the first comment is that the paper classifies, the first thing I like is that the paper classifies empirical studies, not just with respect to the sort of targeted asset or the purchases, but specifically on the basis of the transmission mechanism that shed light on. And I think that this is interesting because this is the key point where we can make progress and improve our understanding of the empirical power of mechanisms that maybe have only been emphasized in theory. I also like that the paper has this devoted section, this section devoted to ETF purchases. As Kozuke emphasized, this is a very special feature of Japan. It's a sort of, you know, you would naturally expect a similar section also on the effects of purchases of real estate investment trusts, but unfortunately, as Kozuke emphasized, there is, at least as yet, there are very few studies, there are no studies doing this, and so this part is unfortunately not there. Finally, I like the fact that, you know, there's this section on the impact of balance sheets on inflation expectations. And this is crucial, of course, for Japan, for the BOJ. The paper also emphasizes that various economists have saluted this QQE measures as a regime shift that would create a big impact on expectations that would take Japan out of the liquidity trap. So it's very important then to look at these measures, even if sadly the results seem to be that you know, expectations haven't moved much. So to finish off, what instead are my few suggestions? So I started emphasizing that there is this important difference between you know, early QE and balance sheet policies as of QQE. And so I think it would be, from this perspective, it would be useful to also separate the empirical evidence. So focus on empirical evidence, which is a result of QQE or later policies, vis-a-vis evidence that is based on the older policy. In a way, the early experience is interesting to the extent that it produces effects in spite of the fact that we would have expected it to be irrelevant. And instead, QQE and more recent policies are interesting because they're also much more comparable to the experiences of other central banks. Now, of course, you know, one cannot slice an issue into too many sub-items, but maybe one option would simply be, just as a suggestion, to split, for example, the discussion, especially of purchases of JGBs, into impacts produced in the first QE and second QQE and so the QQE periods, even if there is, if I understand correctly, there's little on the QQE experience. This, I think, will still be worth discussing separately. Besides, there are also interesting dimensions here because it seems like QQE, for example, seems to have performed worse than one could expect along some dimensions. For example, it had a smaller positive impact on bank lending than the older QE. And Kozuke suggests that this may be due to the fact that by the time QQE was implemented, the non-performing loans problems in the banking sector had been sorted out. And but this is again interesting because it suggests that the particular channel of transmission of QE, you know, what Brunner Meyer calls stealth recapitalization, is indeed very important for the transmission of this policy. And when banks are already well capitalized, recapitalizes them, whether stealthily or openly, is not very useful. Okay, from a comparison with the chapters in particular, or the chapter on the Fed, I think it would also be interesting to have a slightly longer historical account going backwards. I'm probably projecting my own ignorance on the profession, but I think that we all have, you know, some knowledge of the history of the Fed, but we know much less about the Bank of Japan. And finally, I think it would also be interesting to have a little bit more discussion on the liability side of the balance sheet. Here I have in mind especially the role of central bank reserves. Since January 2016, the Bank of Japan introduced this negative interest rates policy. The ECB has done the same, a bit earlier, and these experiences has had two effects. On the one hand, it was, you know, an additional dimension of monetary policy accommodation, but on the other hand, it generated side effects on banks' profitability. So it became a very important sort of item in the monetary policy debate. And from this perspective, negative rates and the large stock of excess reserves are become also important. And it would be interesting for the chapter to discuss to some extent whether this is you know, been an important item also in Japan. I presume that, for example, the concern about the introduction of multiple tiering suggests that this was indeed the case. And by the way, I take this comment also to my own chapter, which I think should be a bit developed on this dimension. But that's it. I think I hope I'm on time, but to conclude, I just want to reemphasize my main 2 points. So Japan is a very interesting case studies, I think for monetary economics in general, not just for central banks. And I think the Kozuke's chapter asks exactly the right questions, and he provides this comprehensive answer covering all the key important aspects. Thank you.
Thank you very much, Oreste. We have a few minutes for general questions. Please just unmute yourself and ask the question if you have it.
Can I ask a question?
Please.
It's Ricardo. One question that I would like to answer, Kosuke, if you can. How was the Bank of Japan able to do yield curve control? It is very, very hard, usually historically, for central banks to pin down 2 interest rates, 2 points in the yield curve without losing control of the material of their balance sheet. That's only been historically. The BOJ seems to have managed. People always say moral suasion when I ask this question. Since you've thought about it a little bit, you can explain. And by the way, last week, Australia stopped being able to do it once there was any pressure. How has the Bank of Japan been able to do it for so long?
Actually, my impression is they have perfect control.
No. Don't answer. Take the questions first. If there is time, we'll go for answers. Let me ask mine, actually. The fiscal implications that the Bank of Japan would run large losses should short rates go up. There seems to be much benefit in relating that to interest on reserves, right? That seems to be an important bit, whether central banks will want to continue to do so, or the implications on bank capital, as Oreste was also talking about, should they decide not to pay interest on reserves when raising interest rates, and the political economy of that.
Any other questions?
I'll ask not a question in some sense, but maybe a request. I think it could be very useful to talk a little bit about how the Bank of Japan actually implemented these various programs. Just something on the mechanics, and are there lessons for other central banks that might want to go down similar roads? Just kind of what were the operations, and how are they operated? Were there problems? Are there pitfalls that others could learn from? Would be very interesting.
Any other questions?
I'll throw in one more. This is not specific to Japan, but I actually did not know this, that these balance sheet interventions had real effects, but not effects on inflation or inflation expectations. I mean, this is something that we find, around the world, but it goes back to being a statement about the Phillips curve, whether it's there or what it looks like. So is there anything in Japan that sheds light on this question? Why is it that we seem to have effect on, in general, asset prices, on lending, on real activity too, but not on inflation? And in the end, if we are able to have an impact on activity, do we really care about inflation that much independently?
Okay, are there any other questions? If not, I think we have a few minutes for Kosuke to try to answer some of those.
Okay, so thank you very much for giving me many interesting and useful comments. And so I appreciate Oreste's comments, and I will try to incorporate it. And regarding Ricardo's question about yield curve control, my impression is they have perfect control over 10-year yield. And I think it is interesting to investigate why that's the case, as you said. And interest rate on reserves, yes, I think, I should discuss it. And also implementation of how the BOJ implements. So I will try to incorporate as much as I do. And regarding the last comment on why inflation remains low, and as in many countries, people find flat Phillips curve. And also in the case of Japan, they do find sluggish inflation expectations. But still, I think we need to understand it. But anyways, thank you very much.
Okay, thank you, Kosuke, and thank you, Kosuke and Oreste, for getting us off to a great start and keeping everything on time. So our next talk will be, we're just going to reverse the order. The next talk will be by Oreste on the ECB balance sheet. Oreste, if you could share your slides.
Sorry, I'm just doing that. Sorry for being slow.
Okay, we see them in full screen.
Perfect. Okay, thank you very much. Okay, this is now about the balance sheet of the ECB. Let me just quickly try, yes, flag my disclaimer again, and then start. Okay, start by showing you how the chapter is. This draft is now organized. So I start with an introduction, attempting to highlight the key distinguishing features of the Eurosystem, the features that, in a way, make it, more complicated, but also more interesting from the perspective of economists. One feature is that financial markets in the euro area remain imperfectly integrated, and therefore, for example, the financial crisis in 2007-2008 also led to a fragmentation, more fragmentation across countries, and the size of the liquidity providing operations which were conducted by the ECB in these early phases of the crisis was also heavily influenced by this cross-country fragmentation. The second feature is that EMU does not have a central fiscal capacity, and so common treasury issuing fully safe nominal bonds is not available. And from this perspective, it was essentially impossible to have a pure form of QE in the euro area. So when QE was implemented, it was therefore subject to a number of limitations from risk management reasons. And finally, large-scale asset purchases were implemented in a sort of later stage in the euro area. And this is also an interesting feature from the perspective of understanding the effectiveness of QE in a period of calm financial conditions. Then section 2 just briefly reviews various classifications of different balance sheet policies, classifications that have been used, that are used either in ECB official documents or also taken up in some papers, and I think it's useful to review them to help people navigate through these papers. Section 3 then has also an overview of the evolution of the Eurosystem balance sheet over time. Here I have I'm lucky to be able to start just in 1999 with the start of the European Monetary Union, and I also provide this taxonomy of the various measures introduced by the ECB over time. And section 4 reviews all these available studies, measuring the effectiveness of the various policies. I sort of split this review in 3 parts. First, I have a review of the impacts on financial asset prices, and then I review the evidence on the broader impact on these measures, split in the sort of liquidity providing operations to banks from the more QE type measures, and therefore impacts on GDP and inflation. So, and then section 5 offers a few concluding remarks on the broad lessons that we learn from this literature. Okay, I will be very brief on chapters 2 and 3. So, as I already mentioned, chapter 2 discusses a few sort of classifications of non-standard measures that have been used in some papers. I also have discussed to some extent transmission mechanisms of monetary policy. I think that many macroeconomists remain persuaded that only the QE can only produce effects via signaling, and therefore I think it's useful to provide an example, a simple example of how credit policies can also produce effects, essentially by modifying the stochastic discount factor or leverage constrained agents in the economy. So in this way, I think it's useful to understand that QE should therefore be expected to play some role, not only on the assets directly purchased by the central bank, but also more broadly on all financial asset prices. And just to be clear, I have this simple example which draws on the work by Gertler and Carradi, Gertler and Kiyotaki, and especially an application by Luigi Boccola in a JBE paper. Okay, then I summarize again these ways in which the balance sheet policies have been classified. I have here, 3 sub-bullet points with this example. Let me just quickly mention this targeting impairments versus providing accommodation sort of distinction. That refers to the fact that I want to mention it because I will also discuss it later, but it refers to the fact that at the beginning of the euro experience, there were many measures that were implemented in order to prevent that financial market turmoil would spill over into the real economy, but without necessarily producing independent or additional monetary policy accommodation. And these are these early liquidity providing operations that again were implemented by the ECB. And instead, later on, ultimately with QE policies, the objective changed, and the focus was more indeed on providing accommodation once the interest rates had reached the zero lower bound, or the effective lower bound in the euro area case. And I'm emphasizing this because, again, I will review these two evidence on these two types of measures separately. I also, the other classifications, active, passive, separation principle, this is more like, I think is to some extent ECB jargon, which I think it's useful, again, just for the sake of clarity. Then section 3, as I said, reviews the history of the euro system. Here I'm showing a few key items, aggregated items on the ECB balance sheet. On the top side of the graph, you have assets. On the bottom side, liabilities. I mainly focus on assets and on 2 items specifically. One is the item called lending to credit institution, which is the dark blue histogram on the top, and which played an important role in the early phases of the crisis. And the second one is the item called securities held for monetary policy purposes, which is this sort of dark yellow item at the top again. And you can see that this becomes much more relevant in more recent years. Sorry, let me just say here that I highlight here along the way, I highlight here 3 sub-periods. One is the very beginning, in which the balance sheet was sort of not interesting from a monetary policy perspective. And then the first period, in which there were many liquidity providing operations. The ECB provides liquidity mainly to repurchase agreements. And before the crisis, they were mainly at short maturity of 1 week. And then with the crisis, there was a progressive lengthening of the maturity of these operations. And in 2011, this operation reached the 3-year maturity. And all of this is reflected in this item I mentioned before, lending to credit institutions. And then in a subsequent phases, so after 2014, so the QE starts, and this is the so again, these are the 3 main phases that I identify in the review. Okay, so then I review the literature on unconventional on the effects of these unconventional measures, and I split the review here in 3 parts. So the first, I look at and actually I should emphasize that there's a literature here which is really expanding, and in many cases, though there are sort of smaller differences between papers, and maybe many similarities. So I sort of adopted as a selection criterion. I focus mostly on papers that are published in referee journals, although not exclusively. Okay, so I split the review into 3 parts. The ones the one highlighted in this slide. So first, I look at the impact on bond yields and other asset prices. Then studies focusing on effects, especially on bank lending, but also on portfolios of institutional investors. And finally, I review estimates on GDP and inflation. And now, in all cases, I distinguish between this initial phase of liquidity providing measures to banks. I will use the LTRO mnemonic for this, which stands for long-term refinancing operations. And then separately, I will have the review of QE measures. Okay, so effects on financial asset prices first. So here, there are a few event studies discussing the immediate impact of these measures, but I think that the central question here is whether these measures, any effects on asset prices are persistent. And because only in this case can we expect then to produce some impact on the economy and ultimately on inflation. So since I made the point that it is useful to analyze separately LTRO type measures from QE type measures, I provide some evidence directly in this respect on financial asset prices over the 2 periods separately. So here I just stand on the shoulders of Jonathan Reffett, Eric Swanson, and others, and estimate the impact of unconventional measures in a VAR with external instruments. I look at 2 variants and multiple asset prices in order to and actually identify the measures with external instruments using 2 types of external instruments. I will not go into the details, but I try to focus on the results that are robust across the various the two instruments. And let me underline that this approach should deliver precise identification of one of the unconventional monetary policy shocks, but it will miss by construction any effects that are anticipated by the markets, and therefore they are already incorporated in asset prices before the day in which the measures are announced. And actually there is some evidence in the euro area that this was the case, at least for the first QE announcement in January 2015. Okay, so just as a sort of reference, let me show you here a few of these results. Here I'm showing only effects of, again, the QE type shock in blue and LTRO type shock in pink. And I'm only showing you for selected variables, again, to give you a flavor. So these are 10-year and 2-year overnight interest swapped rates, and then the dollar-euro exchange rate, and a measure of short-term interest rates. So the main point here that I want to make is that both policies had produced quite persistent effects on the 10-year rate, in this case, the 10-year index swap rate. I should say on the horizontal axis, you say days here, and you see days, and both results are scaled up so as to generate a 1% fall in the 10-year rate. Now you can see that if you look at the LTRO shocks first, you can see that LTROs produce effects through probably a slightly different channel, because you can see that the shock led to a slow but persistent reduction of the short-term interest rate. And so this looks a bit like a forward guidance type of shock. So at least this is probably the case because part of these measures were also conducted. These longer-term liquidity providing operations were conducted at a fixed interest rates over the duration of the liquidity providing operation, and for example over 1 year. And so at least some of them can be interpreted as a form of implicit commitment of a type of forward guidance type. For QE, instead, the things are different, because you see that for QE, the response of the short-term rate is not significant, and but nevertheless, QE, the impact of QE measures is also quite persistent, and I think that this lack of impact on the short-term rate is also suggestive of the fact that the measure produced effects by affecting risk premia. And not in this case as through a signaling channel of future changes in interest rates. So this is concerning interest rates, and the other important variable here is the euro-dollar exchange rate. Both measures again also lead to persistent depreciation of the euro exchange rate, and this is consistent with results in a paper in the JME by Luca De Dola and other ECB co-authors, which directly uses the balance sheet, the relative balance sheet of the ECB and on the Fed in order to identify the shocks, and also finds the strong effects on the euro-dollar exchange rate. Okay, so again, all in all, this is to conclude that these effects have probably these measures both had probably persistent effects on both the exchange rate and the interest rates. I also discussed some evidence on other spreads, but this is less conclusive, meaning that there are some differences across the different identification schemes. Okay, then I moved on to discuss effects. Can I say how long do I have still, Jonathan? Sorry.
Just 3 minutes.
Okay, good. Then I need to speed up. So LTRO, I think effects on LTRO on bank lending. This is probably the most interesting part of this literature because, or at least the more persuasive, because these papers can use all the information from disaggregated bank level data, sometimes also matching this data with firm level data. They broadly find that there are expansionary effects of, they especially focus on this 3-year longer-term refinancing operations. They focus on various countries, they're listed here, and in general, they find expansionary effects on lending, although these effects are, not huge. They don't correspond, for sure, they don't correspond one-to-one to the amount of lending that these banks took at longer-term maturity. And in fact, a few of these papers also highlight that there is evidence that the LTRO operation led to some restaking, meaning that some banks use them in order to increase their holdings of sovereign bonds, especially in countries under stress, according to the, using the language of that time. And so this is one of the side effects of these measures that can be discussed, and it has been discussed also in these earlier years. So then I also discuss evidence from LTROs, from VARs and from the SGE on the overall on output and inflation. And let me just say here, since I don't have much time, that these effects are found to be, sizable. These are, effects that go through the fact that intervention can prevent the freezing of interbank markets, and therefore can be very helpful in preventing a credit crunch. And of course, though, all the DSG-based evidence also relies on you trusting the model used to provide that evidence. Even of course, they're also useful because they can help you provide a rigorous, construct a rigorous counterfactual exercise. Okay, finally on QE, here I discussed two strands of the literature. One looks at portfolio allocations by sector. So the idea here is to look at what, which sector the economy sold to the ECB when QE purchases started. And there are results suggesting that this was mostly the foreign sector and secondly, the banking sector. And there are also some interesting results within the banking sector, highlighting differences between the sort of southern countries and other countries in terms of how the gains from the balance sheet gain, the valuation gains generated by the QE policies were used. And to conclude, I look at model-based evidence. This is, there are many papers that are based on DSG models or what can be called as a two-step approach, by which people look first at the impact on yields and then use the yields in a structural model in order to simulate the impact on the economy. I don't go to the details here of the various effects, but I highlight the purchases of the amounts of roughly 10% of your GDP, which is more or less the amount that was announced in January 2015, are found to produce effects in the order of magnitude of 1% on GDP and 0.5% or a bit less for inflation. Okay, so this is just, again, a rough order of magnitude. So let me conclude here. I have a few items that I would like to still add to the chapter, but otherwise, I think that now balance sheet measures are part of the monetary policy toolkit, and the euro area evidence highlights that there were significant and persistent effects on yields and on the exchange rate. But these results, these results are also suggestive of positive effects on the macroeconomy and of inflation, although the effects are not huge. And I think that improving our understanding of the transmission channels of these measures remains, a key priority for this literature. So, thank you.
Thank you, Oreste. And the discussion will be given by Kosuke. Yeah, we see your slides. But you're muted.
And we don't see your slides anymore.
But you're now unmuted. So
Okay.
okay, now we see your slides and you're unmuted. Good.
Okay,
Go ahead.
thank you.
Thanks.
So, okay, so this is a let me start. Okay. So this is a very nice overview of ECB balance sheet and policy. So first, so he documents the evolution of balance sheet. And what I like is, so he explains policy according to liquidity measure and QE type measures, so which make the reader very easy to understand what's going on. And Oreste provides a new empirical analysis by using a vector autoregression. And again, so the conclusion is liquidity measure works like a forward guidance, and QE measure works to reduce risk premium. And then he reviews some interesting empirical literature. Okay, so that's what's going on. And the policy effects. So he finds persistent effects on asset prices and also positive effects on bank lending. And compare with those asset prices, effects on output and inflation tend to be smaller. And yeah, those findings are common to the Japanese experience as well. Okay. And what I like, and also what I feel very interesting, is the multi-country nature of Eurosystem balance sheet. So Oreste emphasizes this in the introduction. So the important thing is, so the Euro area lacks the central fiscal authority. So therefore, there's no single area-wide safe assets, and government bond markets are segmented, and some government bonds are regarded as risky. So therefore, the distinction between private and public assets are kind of blurred. And so I think this feature is very unique to the Euro area. So therefore, I think it would be beneficial to the reader if the following things are explained, like institutional arrangement and how ECB capital is built. And finally, what happens if the ECB incurs some losses, and how those losses are going to be shared with national central banks or national governments. So those information would be very informative to the reader to understand the uniqueness of the, how unique the ECB's environment is. And also related to this issue, I'm wondering if there is some literature on the composition of ECB purchases of assets, like how much the ECB purchases bonds of different member countries and how those are allocated. So I think those explanations would be also useful. And similar things apply to purchases of private assets. And what I have in mind is the debate over purchases of ETF by the Bank of Japan, because at that time, the bank tries to be neutral against resource allocations, which sector benefits and which sector do not. So the Bank of Japan wants to be neutral about that. But at the same time, they want to affect stock prices effectively. So therefore, neutrality versus efficacy of policy, I think this is, an issue in the Euro area as well. Okay. And also, finally, another interesting feature of the Euro area is, as many of you know, it consists of many countries which faces asymmetric shocks. And also, yeah, as you know, different situations regarding the central government. So therefore, each country faces different economic conditions. So then, not only the degree of price stickiness, but the degree of financial conditions are different. Then, how different policy effects are going to be across member countries. And Oreste's chapter cites this paper by Albert Tazzi. So that talks about how different countries are affected. But I wanted to see if there are more studies on this heterogeneous responses to the single policy. But overall, I liked this paper quite a lot. Thank you very much.
Thank you very
Maybe
much, Kosuke.
I could have talked more, but
Thank you. Are there any questions on Oreste's chapter or comment? Andreas, go ahead. Oh.
Yes, thank you. Can I go first?
Yes, go ahead, and then Ricardo.
All right. So I think one of the specificities of the ECB, I guess, is also about the collateral policy in the lending operations. And I mean, I guess this hasn't been studied that much in the academic literature. I mean, there is some work by Ulrich Binzeil and Charles Neuborg and so on. So I was wondering to what extent you get into that, because this is indeed quite interesting when you compare that compared to the other central banks like the Fed or the Bank of Japan that primarily implements monetary policy based on government assets. And so getting at the haircut policies of the ECB, that would be really interesting in terms of the mechanics and so on and its implications.
Thank you, Andreas. Ricardo?
Along similar lines, an even bigger specificity, I would argue, of the ECB or the Euro system is that you have multiple regions. And so as a result, there are multiple balance sheets of different central banks, as well as different assets or heterogeneity in the assets, even among government bonds that it holds. But in your chapter, there was almost, as far as I could see when I was reading it yesterday, no reference to that. And so isn't that, what have we learned in terms of the impact of these policies on the fact that you buy more Italian bonds, less Belgian bonds, on the price of those? Why should we consolidate and only look at the Euro system as a whole when there's these strict rules that X% of the bonds bought, half of the Portuguese bonds have to be bought at the Bank of Portugal? These seem like very unique things to the ECB, but that are either not important. So maybe you want to state that they're not important, or they are important, in which case they should be discussed in this chapter because they have played a role in others, of course.
Thank you. Bill?
Thanks, Jonathan. So two questions. One is related to the discussion, to the other comments that you received, but perhaps a bit broader, which is when the ECB was founded, at least as to an outside observer, it appeared that it adopted the Bundesbank's philosophy that investing in government debt was distortionary, and that the safest thing would be to make loans to financial institutions broadly and least distortionary. But then that philosophy seems to have changed, although I'm often told that it didn't really. So in that now the ECB buys a lot of government debt. I think tracing out the evolution of that thinking would be important and fascinating. Secondly, there's some very interesting developments that happened within the Euro system in relating to the differences between the NCBs and the ECB. And here, in particular, I'm thinking about the target 2 imbalances, which struck me as, the Europeans collectively providing credit to the Southern Europeans in a manner that wasn't really sort of authorized. So I think that would be a very interesting thing to discuss as well.
Thank you. Angela?
Hi, sorry. So, Oreste, recently I was presenting my paper and Oliver Wang made a comment about the typical monetary policy transmission pipeline. There are 3 steps. First, central bank to money market, then down to the debt and equity market, and finally to the goods and services, right? To me, it seems that your chapter focuses more on the second and third steps rather than the first one, which is critical. It could be the bottleneck, actually, of the transmission. I don't know if you want to consider this point. Thank you.
Bill English, you had your hand up and now it's down. Do you have a question?
Bill Nelson took my question. Thanks so much.
Okay. Are there any other questions?
Could I quickly unask the Bill Nelson question? If you get into target 2, I think you'll never get out of it. So a lot of reason to be very cautious in going there. Having said that, a lot of people, including Kosuke, brought this point up. I mean, in the US, we kind of think of the Federal Reserve System as one entity, and it's natural to aggregate. And maybe we shouldn't, but we do. But in the euro area, it's actually really interesting when thinking about the ECB balance sheet, right? Is this the relevant balance sheet? Should we be thinking about the national central bank balance sheets? Should we be consolidating those together and then keep the ECB separate? Or, are there so many different entities? And how do these things relate? Some discussion of that and the open questions would be most welcome. In particular, even if you don't want to get into the target 2 debate, to what extent the discount lending programs are coordinated, to what extent these are reflected or should be reflected on the ECB balance sheet as opposed to national central bank balance sheets, and things of that sort seem to be some of the basic mechanical things about the ECB balance sheet.
So now I want to know if Bill English's question was about the target 2 imbalances that he took back, in which case we outvote you.
Yes, I was interested in target 2, but Rafet is definitely right that he risks stepping into a morass. But it is a huge difference between the ECB and other central banks that may be worth exploring. I think Rafet's broader and maybe less likely to step into a morass formulation of just thinking about what does it mean when you have different national central banks and you have an ECB, and how should we think about that as an entity or a bunch of entities? Maybe that's a more fruitful way to think about it.
Oreste, I think you have 2 minutes for any comments any quick comments and replies you might have.
Thank you, Jonathan. Okay, let me just first thank Kozuke. I think that of course I agree. These cross-country differentials are interesting. I think so. I need to clarify. I think that I do refer to these issues like how the ECB capital or the Eurosystem capital is affected by potential losses, how purchases are allocated across countries. But okay, this is something which I need to make sure to have clear. So the general principle of market neutrality has also been adopted by the ECB, but then in practice, what that means is often is not so straightforward. Let me just take one broad issue on you mentioned a few sort of broad items. One is collateral policy. There is indeed, there's been changes to collateral policies, and that's interesting in various respects. I do refer to it to the extent that it does play, or at least it is argued to play, some some role in explaining the effects of some policies, but going into the details of the collateral policy and its evolution, I think is beyond this chapter. Now the multiple regions, Ricardo asked, do they make a difference? Of course, they're bound to make a difference also in the design of these measures. And target 2, is certainly one way. I must say, it's my concern with target 2 is that, okay, one is the morass that Bill English referred to, but also in a way it becomes really interesting and important if you start contemplating the possibility of a breakup of the union. And this is something which it seems to me that this sort of takes you to a type of discussion which then becomes then nothing. It becomes unbounded in terms of where it can take you to. And for the money market transmission, for Angelo, I do refer to the money market transmission as well. There is some evidence on this part as well. And but I suppose, okay, I need to make sure that this is also clear, maybe clearer in the current draft. Thank you all.
Okay, thank you very much, Oreste. Next up is the Fed balance sheet. Bill, are you presenting it, Bill English?
Yes, I am. I'm going to put up my slides just now, just a sec. Okay. What are you seeing now?
Yeah, we're seeing your screen full screen.
Okay, and
we hear you loud and clear.
Slides are changing?
Yep, files were changing there. Yeah.
Excellent.
Thank
okay.
You.
So thanks very much, as everybody has said, to Rafet and Jonathan for organizing this. It's great to be here, even if it's sadly on Zoom yet again. This is joint work with Chris Dawsey and Brian Sack at D. Shaw. We took a somewhat different approach to our chapter on the Fed balance sheet than the previous papers on the BOJ and ECB. What I want to do is talk briefly about background on the Fed's balance sheet, give a little historical perspective, focus in on the balance sheet prior to the crisis, then the balance sheet since the crisis. I'm going to have a very little to say on Fed lending and private asset programs. I'm going to leave that mostly to Bill Nelson and Brian Madigan in the next session, and end with a couple of concluding questions, not concluding remarks, I think. So here's a snapshot of the Fed balance sheet in a recent week. Total assets about 8.5 trillion, total liabilities also about 8.5 trillion. The Fed's capital is very small. The main assets are securities holdings, so that's treasuries and also agency debt and agency MBS, about $8 trillion. And in fact, most of the other assets in this table are unamortized premiums on securities held. So it's an even larger fraction of Fed assets are securities. That's basically what the Fed has. There is now a small amount of credit, discount window loans to banks, Section 13(3) loans to others, and the swap lines with foreign central banks. Those get big, as I'll mention later, but they tend to get small again pretty quickly, and they've gotten small again. On the liability side, the biggest liability by far is reserves of banks, over $4 trillion. Why so big? Well, because as we discuss in the paper, when the Fed purchases securities, all else equal, the amount of the purchase goes into bank reserves as the Fed pays the person who sold the security to the Fed. That money makes its way to the account at the Fed of the bank that holds the account of the seller of the securities. So reserves have gone up a lot. This other large item is reverse repurchase agreements. So that's one leakage from that flow from purchases into reserves that I mentioned a moment ago. If the depositors at the banks take the money out, they put it, say, into a money market mutual fund. Money market mutual funds have access to the Fed. They can park money at the Fed, much as banks can park reserves at the Fed. And when they do that through the reverse RP program, and end up with RPs at the Fed. And those are also very large, about 1.5 trillion right now. The third large liability item is currency. Currency just grows over time with the size of the economy, though it actually grew a lot during the pandemic as people evidently held a lot of extra currency. One thing to remember about currency in the US is a lot of it is held abroad. Probably 2/3 or something of it is held abroad. So that's an introduction to the Fed's balance sheet. Now, I want to go back and talk about a little bit of history, a little bit of historical perspective, because the Fed's balance sheet has changed a lot over time. This chart shows the size of the balance sheet and various components on the asset side as a percent of GDP. And what you see is big changes in size and composition over time, reflecting changes in the Fed's authority, changes in the economy or the shocks that are hitting the economy and the financial markets, and the Fed's responses to those shocks, and so the policy that is chosen to implement. Back in the early days of the Fed, the first decade and a half or so, the Fed's assets were to a large degree gold. We were on a gold standard then, and so the Fed was holding a lot of gold. And aside from gold, the Fed was implementing policy through operations with banks. So it was doing discounting for banks. So discount window lending, more on that from Bill and Brian in a bit, and also buying bankers' acceptances, and those were large assets. And then an additional asset that was substantial was purchases of Treasury securities. And so that was kind of the way the Fed managed its balance sheet and implemented policy. In the Depression and in World War II, things changed radically. The balance sheet got huge. First of all, securities went up a lot early in the Depression. The rules of the game were changed by Congress so that Treasury securities could be used to back currency. And also, just because of the Depression and efforts to assist the recovery, the Fed did large-scale open market operations then too, as they've done more recently. The amount of gold increased radically during the Depression. Basically, in the run-up to World War II, there was a huge inflow of gold, just a fire hose of gold coming from Europe into the US. World War II began, and the Fed got deeply involved in keeping rates low to assist in the financing of the war effort. And in doing that, its purchases of Treasury securities went up vastly, and that's that teal band at the bottom of the chart. So very large changes in response to changes in the rules of the game, but also big shocks through this period, of course, in the Depression and World War II. After the war, things gradually come back down again. The size of the balance sheet gradually shrinks. By the 1960s, its size and composition are pretty close to where it was rather prior to the financial crisis. So let me turn to the balance sheet prior to the GFC. At that time, the balance sheet was relatively small, as we just saw. The assets were mostly treasuries, and so the Fed was holding treasuries. On the asset side, the liabilities were mostly currency. The growth in currency was accommodated by gradual ongoing purchases of treasuries. And since no interest was paid on reserves at this time, interest rates were well above the zero bound. Reserve balances were very low. And so you had a small balance sheet, and the Fed managed to hit its desired level of interest rates with relatively small purchases or sales, generally transitory, so repo and reverse repo, that added or drained reserves to keep the federal funds rate near the target that was desired by the FOMC. And that's called a corridor system, since the federal funds rate was between the rate paid on reserves, then zero, and the rate at which you could obtain reserves from the Fed, the discount rate. And so the desk got good at this over time, and as you can see in the chart, just shows the funds rate target and the actual funds rate, and on average things are very, very close to target. Since the GFC, of course, everything has changed. In response to the GFC, the Fed took a whole range of extraordinary actions. Initially, a lot of it was emergency lending. That made targeting the funds rate with the old corridor system very difficult, because it added a lot of reserves. As the Fed did its emergency lending, it added reserves, and it added more reserves than the desk could withdraw. So the desk tried. It for example, allowed Treasury bills to run off. So Treasury securities actually declined as a fraction of the Fed's balance sheet early in the financial crisis. But it was hard to keep up, and ultimately it became impossible as the Fed responded to the Lehman failure, first with massive lending that I'll discuss in a bit, and also with 4 rounds of QE. So I just list them here. The total effect of the QE back in the post GFC period was about 4 trillion net. So a huge increase in the size of the Fed's balance sheet, a huge increase in reserve balances, and that just required kind of, whether the Fed wanted it or not, a shift to a floor system for implementing rate policy, where the federal funds rate was bracketed or held up by the interest rate paid on reserve balances and the interest rate on the overnight RRP program. Happily, Congress had provided the ability to pay interest on reserves. When the time came to remove monetary accommodation, the Fed had to choose how to do it. The decision was, first, they were going to raise rates using those new tools, the payment of interest on reserves and the overnight RRP, and then they'd reduce the size of the balance sheet. They stuck with targeting the federal funds rate, though there was some discussion around that, as we talk about in the paper. Once rates were higher, the Fed had to decide on what would be the policy implementation framework after normalization. What was the new normal going to be? Would they go back to a corridor system? Would they stick with the floor system? In the end, they chose to stick with the floor system and a big balance sheet. So they're going to operate out on the flat part of the demand curve for reserves, rather than trying again to be on the steep part and do small operations from day to day to keep the Fed funds rate near target. And the Fed chose to shrink the balance sheet once it wanted to do that pretty gradually by running off securities rather than by selling them. There'd been a lot of discussion earlier about the possibility of selling securities. They decided to pass on that. They started very, very gradually. There were caps on how much of the repayments of principal they got would be redeemed, how much would be reinvested, and then those caps were gradually raised. And the balance sheet normalization proceeded quite gradually. Indeed, it was completed only just before the pandemic hit. So then the pandemic hit, the Fed began purchases of Treasury and Agency MBS again. The pandemic purchases were aimed initially at market functioning because there was a real breakdown in market functioning in the spring of 2020. And then they kind of transitioned to a more traditional QE program to support asset prices, particularly long-term rates, push them down and support accommodation in financial markets. Those purchases caused the size of the balance sheet to rise astonishingly quickly, with more than 2 trillion of purchases by May of 2020. Those purchases have continued. They're expected to start tapering at the meeting, the FOMCS this week. Another point I wanted to make is the Fed recently introduced a new standing repo program for primary dealers and banks to help improve market functioning, also one for foreign and international monetary authorities. That feels like a step in the direction of targeting repo rates, which is something that was discussed all the way back in 2014. There's also lending and private asset programs that were used. As I say, Brian and Bill will have more to say about this, but there's lending to dealers and money market funds. There was lending to support market functioning. There were swap lines with foreign central banks so they could lend to banks in their jurisdictions. And post-COVID, similar programs were started and a bunch of new programs for direct lending to businesses and governments. This lending is mostly short-term, so the effects on the balance sheet are short-lived. And some of the programs were very effective with small balance sheets. The corporate credit program, the municipal program, just standing there as a backstop seemed to provide a lot of confidence and comfort in markets, and markets then function better. So it isn't necessarily clear that the size of the balance sheet effect is what you want to worry about when thinking about the effectiveness of these programs. So I'll conclude with a couple questions. One is, it just isn't clear to us what normalization is going to look like post-pandemic. The old playbook would shrink the balance sheet really gradually. You wouldn't get down to kind of a normalized balance sheet until the late 2020s, maybe even later, depending on how quickly they get started, kind of how the economy plays out. So there's a real risk of a ratchet effect. Each recession, you buy more stuff, you run off only a little of it. The next recession, you buy more stuff. And it isn't clear that's sustainable. So the Fed may want to consider moving earlier or faster, but that raises a bunch of hard questions about what do you do with rate policy, and how do you manage the effects of moving faster in markets. Our last question was the timely question of what about a central bank digital currency? That could have huge effects on the size of the Fed's balance sheet. If a lot of deposits shifted to CBDC, what would that mean for the management of the Fed's balance sheet? There's a possibility that would mean that banks would be disintermediated. The Fed would have to somehow provide a lot of credit to banks to get funding back to banks so that they could lend. So a bunch of hard questions there. And I'll stop with that. Thanks very much.
Thank you very much, Bill. And the discussion will be, I'm not told, is it given by Bill Nelson?
Brian.
Brian, okay. Is Brian there?
Okay, can you hear me?
Yes, we can hear you when we see your screen. Yep. Thank you.
Great, okay. Well, thanks very much. It's a pleasure to comment on this paper by Bill, Chris, and Brian. Bill Nelson and I collaborated on putting together these comments on the paper, but if I make any errors, that's my fault and not Bill's. Okay, first, I'd like to say that this is an excellent, highly detailed summary of the role of the Federal Reserve's balance sheet in the Fed's monetary policy implementation. Most of the text, as Bill Bill English just noted, provides a historical perspective. Bill Nelson and I have many specific comments on the draft that we'll provide directly to the authors. But our focus as discussants in today's session will be suggestions regarding arguably important balance sheet issues that are not currently covered, but could be considered for inclusion. And I think if Bill and his co-authors were to take any of these up, probably most of these could be fit in to the section that's currently entitled something like balance sheet mechanics. So much of our comments could be summarized by posing the question, is the focus of the article too narrow? Or alternatively, maybe the title is too broad. From the title, you might think that this article is about the Federal Reserve balance sheet. But actually, I think as drafted, it's really more focused on the role of the balance sheet in monetary policy implementation. Maybe that's the right focus. And certainly Bill Nelson and I have backgrounds primarily in monetary policy. So by no means are we protesting the material on monetary policy implementation. But still, some readers of this handbook might be looking for other information pertaining to the Fed's balance sheet that they won't find in the current draft. And by the way, I think that this comment might to some degree apply to the previous two papers as well. And it's really just a judgment call as to what the appropriate scope should be. Okay, to start off, the article could usefully note the public availability of a number of highly relevant documents to the Fed balance sheet. The fact that there's annual publication of audited financial statements of each of the 12 reserve banks. And we'll get back to this issue of the 12 reserve banks statements in a minute. Also, there is a highly detailed and up-to-date financial accounting manual for Federal Reserve banks that's publicly available. I think Bill's paper probably refers to this, but it's worth emphasizing in this context that the Fed's balance sheet is released on a weekly basis, and it provides information along with that on the LLCs, the limited liability companies, collateral held against Federal Reserve notes, and the statement of factors affecting reserves. Well, why is this point important? Well, as monetary economists, we always underscore the importance of central bank transparency and accountability in legitimizing the independence of the central bank. So this would, among other things, inform readers what information is available on this kind of point. Secondly, reserve requirements. The paper largely does not talk about reserve requirements, but over most of its history, the Fed did have reserve requirements, and they usually accounted for most of the reserves. And many central banks besides the Fed have or have had reserve requirements. The article doesn't discuss this really at all. The article could explain the Fed's evolving view of reserve requirements in conducting monetary policy, the considerations that led to the Fed's legislative request to pay interest. And those considerations really were focused on required reserves, interest on required reserves, to eliminate the allocative distortions accompanying the absence of interest on required reserves rather than interest on excess reserves. And the very recent decision by the Fed to drop reserve requirements to zero. Well, there are many, many reasons why this could be important to discuss reserve requirements, but just to pluck out one, there's lots of confusion in the public and even among economists about reserves and fractional reserve money. So some explanation of that could be helpful. As I alluded to earlier, the Fed publishes actually 12 Federal Reserve banks balance sheet statements of condition, as well as a consolidated reserve, a consolidated balance sheet for all, consolidating all 12 of the balance sheets. Why is this important? Well, most often it isn't, but it occasionally comes up. The discussion that we just had a bit earlier in the session on target 2 balances would provide a point of reference for the issue of the consolidation of the 12 Federal Reserve Banks balance sheets, and also sets up, at least pointing to the fact that the Fed is not totally immune from the target 2 type questions, in that it needs to go through an annual settlement procedure involving the so-called inter-district settlement account. This admittedly is a very arcane issue, but occasionally even people in the public become aware of it, as in 2012. It may also be worth noting explicitly that the Fed's limited liability companies, for example, the corporate credit facility, are separate legal entities that take risks to help stabilize financial markets. And because of those risks, each of the LLCs is consolidated onto the balance sheet of the Reserve Bank with the primary responsibility. And the notes to the Federal Reserve Bank of New York financial statements explain this. Why is this important? Well, the Federal Reserve is an independent government entity that takes risks, different kinds of risks, and an explanation of this would help the public and readers understand how such risks come to be appropriately reflected on the Fed's balance sheet. Accounting for SOMA securities. The Federal Reserve Board has decided not to adopt GAAP, generally accepted accounting principles, across the board in the Federal Reserve Bank's balance sheets. And it went through it provides a careful explanation of that decision. And I think the decision, when it was reached, was convincing. It says amortized costs rather than the fair value presentation more appropriately reflects the financial position associated with the bank's securities holdings, given the system's unique responsibility to conduct monetary policy. Although there may be fluctuations in securities values, these unrealized changes in value have no direct effect on the quantity of reserves available to the banking system, or on the ability of the reserve banks to meet their financial obligations and responsibilities. I think that emphasis on reserves was completely appropriate, and this decision was correct when the decision was reached. But now, post-GFC, there really is no focus on the precise quantity of reserves, apart from the fact that they're huge. And therefore, the rationale for the divergence from GAAP becomes a bigger question. Finally, I'll wrap up with noting that the article could discuss the Fed's capital accounts in more detail, how member bank capital is paid in is determined, what member bank capital means, and very importantly, what it doesn't mean. And now, a fairly recent development, how Federal Reserve surplus is now set through a statutorily determined procedure. Why is this important? Well, in part, it provides an opportunity to explain why central bank capital is not economically meaningful, and at least in principle should not be viewed as appropriate. But also, as flagged in the paper already, Federal Reserve surplus does crop up from time to time in the broader context of macroeconomic policymaking. Thank you very much.
Thank you, Brian. We have a few minutes for some general questions.
I'm happy to go.
Go ahead.
While other people get started. Let me ask one to Brian first. Is Brian Madigan without a beard Brian Madigan?
It's an imposter.
Well, more seriously, I found it interesting that Bill thought the Federal Reserve balance sheet had normalized just before the pandemic. And that I think, is an interesting choice of word on what we should think of as a normal balance sheet for a central bank, right? I mean, it didn't look much like the balance sheet before the GFC. So I would benefit from some discussion of whether we think that the times have changed and therefore the definition of normal has changed, and we shouldn't be thinking of a balance sheet that looks like the 2007 balance sheet at all, or there's some other dimension of normalcy that one should have in mind.
Any other questions or comments? Okay, well, Bill, we have 2 or 3 minutes for you to say anything in reply to Brian or Rafet.
Okay, thanks, Jonathan. Thanks to Brian and Bill for their constructive comments. This is really helpful. We like many others working on this project had too much to cover in our chapter, so we had to figure out kind of what to drop and what to keep. We tried to focus on issues that seemed helpful for a handbook on financial markets. So we focused a lot on the Fed's operations in financial markets. But some of the things that Brian pointed to did give me a twinge that it seemed right that they should get more discussion. We did talk, the authors talked about Fed capital and Fed income. We had footnotes in the paper pointing to those issues, but that may not be enough. We didn't do much on the liability side. We mostly focused on the asset side. But I agree, reserve requirements are an interesting point. We actually had a chart, and we're thinking about some discussion on the liability side over a long span of time. It's kind of interesting. Excess reserves went through the roof back in the Depression, and then they came back down again, and they've gone up through the roof again lately. So there is a story to be told on reserve requirements and excess reserves. So we need to rethink a little bit what we need to cover here. The problem is it needs to be pay-go. We've got to drop something to add something, and that will be hard and painful. But anyway, thanks very much for the comments, and we'll think about them hard and maybe get back to you for some additional input.
Thank you very much, Bill, and thanks to everyone for keeping things on time. And the first 4 chapters are all very much fitting together. And so we're now going to have central bank lending by Bill and Brian. I think Bill is presenting.
That's right. Let's see. Can you see my screen now?
Now we can. Yeah.
Great.
Thank you.
Okay. So Jonathan and Rafet, thank you very much for the opportunity to write this chapter. This is a chapter on central bank lending, co-authored with Brian Madigan, and I will proceed given the limited time. So quickly, I will say I'm going to be providing some highlights from the chapter. This isn't going to be a summary of the chapter. For example, there's a lot of discussion of the history of central bank lending. We do focus on the Federal Reserve that I won't be highlighting here, including how the monetary policy regime focused on non-borrowed reserves and borrowed reserves, and there's a whole bunch of stuff. But I'm just going to be talking about a few highlights, focusing on some recent work that I thought folks might find interesting. And then in addition to a couple important takeaways, talk a bit about stigma, talk about central bank lending and liquidity requirements, the standing repo facility, and if there's time, moral hazard. So to start, here's a quick overview of the Fed's general normal lending operations. And I'd say at the outset,
I'm still only seeing your cover slide, I'm afraid.
Really?
Yep.
That's strange. Okay, hang on. Do you see anything now?
Well, now we see the PowerPoint in non-presentation form. I mean, can you just page down through that and see?
That'll work.
So that's how it works, and it's fine. It's not full screen, but that's fine. So let's just go with that.
Okay, and can you see it now?
Yep, I can see it now.
Okay, great. All right. Regular Federal Reserve lending. First of all, it's called the discount window and the discount rate, not because the Fed used to lend at a below market rate, but rather because the Fed used to provide credit by discounting notes. It doesn't do that anymore. It now provides advances. So basically, the Fed extends regular discount window loans to depository institutions, commercial banks, thrifts.
Sorry, but are you on, because we see what's slide 2 outline. Is that where you're trying to be?
All right. I think the problem is that if I move the screen onto my, so you're going to have to watch me stare up and to the right. Can you now see?
Yeah, now we see regular Federal Reserve lending.
Okay. This has not happened to me before. All right, there's 3 types of lending. Primary credit is extended at an above market rate to sound sound depository institutions on a no questions asked basis. Secondary credit is provided to troubled depository institutions as a bridge back to market funding or to resolution at a rate above the primary credit rate. And the seasonal credit rate, the seasonal lending program is provided to community banks with seasonal funding needs at a market rate. And it is by far and away the largest lending program in terms of the amount of use. All these loans are collateralized. The Fed takes a wide range of collateral, including, and mostly banks pledge their large books of their loans to the Fed. That collateral is pre-positioned at the Fed and is actually very rarely lent against. As last year, for example, the Fed had $1.5 trillion worth of collateral. In addition, the Fed, of course, makes emergency credit loans. Those can be extended to non-banks in unusual and exigent circumstances under the authority granted in Section 13.3 of the Federal Reserve Act. Now, prior to the global financial crisis, the Fed hadn't used that authority to extend credit since the Depression. But of course, the Fed made extensive use of it in the great global financial crisis, extending credit to individual institutions that were in trouble, as well as through broad-based facilities. Now, the Dodd-Frank Act removed the Fed's authority to lend to individual institutions. But during the financial crisis, during the COVID crisis, the Fed immediately rolled out almost all of its global financial crisis broad-based facilities, as well as adding a few more. I note the Fed can also lend to anyone against Treasury or agency collateral for any reason using Section 13.13 of the Federal Reserve Act, but that's rarely discussed. There's some important disclosures associated with lending that the Fed provides. So every week, the Fed publishes the aggregate level of reserve balances. It used to provide, the aggregate level of its balance sheet, including the aggregate level of deposits. I'm trying to look at the screen rather than at my slides, so it's tripping me up. Actually, and then up until last year, the Fed provided discount window lending by Reserve Bank at the weekly level, on a weekly basis. But they stopped doing that last year in order to obscure that to some extent, so that lending was it was a bit harder to figure out who had borrowed. Now, the Fed also must disclose individual details about individual borrowings, including the borrower, naming the borrower after 2 years. This is something that was added by Dodd-Frank. And that includes actually details about open market operations and who was participating, something that's relevant when thinking about the standing repo facility. It has the same disclosure requirements. The Fed also has to disclose details on individual loans extended under 13.3 1 year after the facility that it extended the credit under was closed. And then the Fed is actually disclosing up to starting 1 month after they made the loans, I believe, details about the lending that they did that was capitalized by the CARES Act last year. All right. All right, what are some important takeaways from the chapter? So first of all, Brian and I really would like to emphasize that most of the time, central bank lending is unremarkable. So for many central banks, the loans are simply a counterpart to currency and reserve balances. Even in the United States, loans are normally made in normal times. So central bank lending should not be equated with lender of last resort lending. They're quite distinct, and the even lender of last resort lending is itself a pretty ambiguous term, because then you have to ask, well, what does it mean to borrow because reserves are short in the market at the end of the day? Secondly, the primary purpose of the central bank providing a contingent backup source of funding is to prevent liquidity shocks from becoming liquidity crises. So if an institution is worried about its liquidity or the liquidity available in the market, it could sell assets at fire sale prices. It could stop lending short-term, providing liquidity to others, and it could seek to borrow longer-term, driving up term rates. Now, all of those actions are going to worsen the liquidity situation for others. By contrast, if the institution has a reliable source of backup funding that it would be willing to use, then it will provide rather than hoard liquidity. So that willingness to use it is important, because as is generally understood, there's a widespread stigma associated with borrowing from the discount window. And so I want to talk a bit about that. I'm going to start by relaying some information that I got from over the last several months interviewing bank treasurers about their view of the discount window. So I spoke to 7 treasurers, big banks, small banks, foreign banks, domestic banks. None of them would borrow from the Fed's discount window, except maybe if there were a payment system glitch. And they indicated that not using the discount window is deeply embedded in their bank's corporate culture. One treasurer said their CEO would not let them borrow because they didn't want to potentially have to report to Congress about having received a bailout. All stated that if they borrowed, they would immediately notify their examiners. One said that her examiner would be furious if he weren't told. This is a bit ironic and painful for me to observe, because after Brian and I worked on revising the window back in 2003, we visited all the reserve banks and tried to emphasize that they weren't supposed to be sharing this information with the examiners, but I guess the banks now have to share it immediately themselves. They also stated that the only way to remove stigma was that if borrowing was viewed as a business as usual event, not an extraordinary event. That's a very hard thing to accomplish when something is a backup source of funding. Most perceived that there was no stigma currently associated with using daylight credit because that was still viewed as a business decision. Now, some important points about stigma. You can't dismiss stigma on the view that banks will borrow anyway if they have to. It's a common sentiment that I hear. If there's stigma, then the window won't serve as a safety valve for financial pressures, because banks won't borrow until those pressures become extreme. So, for example, I spoke with a lot of banks after the September 2019 repo market event about why they wouldn't lend into repo markets when repo rates spiked despite having a large quantity of reserves. Most of them pointed to the fact that they didn't know what would happen later in the day, and they didn't want to risk having to borrow from the discount window. Another point is that often the objective of the central bank lending is to get institutions to provide credit to other institutions. And the borrowing institution themselves don't need the funds. So if there's stigma, that's not going to work. There's many examples, but I'd name, for example, the Fed's lending facilities last year, as well as in the global financial crisis, to lend to banks so that they would lend to money funds. And then finally, Brian and I wanted to observe that discount window stigma is probably going to be even more difficult to reduce while the Fed uses its abundant reserve framework, because borrowing will be very rare. Now, to understand stigma, it's important to delve into its history, because stigma has existed since the beginning of the Federal Reserve System. And in particular, stigma was deliberately created by the Fed, starting at the outset, to discourage borrowing. So soon after the system began, also in the 1920s, and again in 1955, the Fed took concrete steps to make banks reluctant to borrow, to emphasize that the Fed was a lender of last resort and the banks should not borrow from them in normal circumstances. So if you want to explain stigma, you can't point to recent things. You need to understand where it comes from at the outset. Now, there have been two major efforts to reduce stigma. In 1971, the Fed revised Reg A in a conscious effort to try to reduce stigma by creating a basic borrowing privilege. And then again in 2003, in something that Brian and I both worked quite a bit on, Reg A was revised to make primary credit a no questions asked facility. Both of these can be seen as efforts to make the availability of credit seem more certain. Unfortunately, more recently, the Fed's message has been ambiguous again. So, for example, the Fed recently proposed tightening liquidity requirements on foreign branches and agencies, in part because the branches had made heavy use of the term auction facility in the global financial crisis, even though they were encouraged to do so. Okay, so I'm going to turn now to central bank lending and liquidity requirements. A sort of a defining question about how you think about liquidity requirements is, should reducing the amount of central bank borrowing be an objective of liquidity regulations? Some people think, of course they should, and some people think, well, no, not at all. We lend to institutions all the time. So now in the United States, banks are subject to a whole menu of liquidity requirements. They're subject to the LCR, which is a fixed formula that targets 30-day liquidity, the NSFR, another fixed formula that targets sort of 1-year liquidity. They have to meet resolution liquidity requirements. They need to be able to fund their own resolution. And monthly, they're required by regulation to do monthly internal stress testing at the overnight, 30-day, 90-day, and 1-year horizon and report the results to their examiners. Just after we revised the discount window in 2003, the Fed issued a supervision and regulation letter, SR 0315, that states that the discount window is a valuable addition to liquidity contingency arrangements. But nevertheless, banks are not allowed to assume borrowing from the discount window in their liquidity metrics. And I think this is related to the continuous the problem of stigma. So there were some important results recently, interesting results, I think. In March of 2020, the Fed extended the maximum initial maturity of primary credit loans. They're normally overnight. They extended it out to 90 days, renewable and extendable at the borrower's request. And this was done so that banks could, if they wanted to, boost their LCRs by borrowing. Effectively, all of the lendable value of their collateral could be converted into LCR liquidity if they wanted to. And that's because the repayment was perpetually beyond the 30-day window of the LCR. Also, in some other countries, banks are actually allowed to count lines of credit that they buy from the central bank as liquidity eligible to count toward the LCR. That is a way that you can formalize the relationship between the liquidity available from your central bank and the liquidity assessments of the institution. Okay, I'm now going to turn to the standing repo facility. So in July, as many of you may know, the Fed opened a new lending facility, the standing repo facility. So the facility provides repo credit to broker dealers, to the primary dealers, the large broker dealers that work with the Fed, as well as to banks that use the tri-priority repo system, which is generally just going to be large banks. The extension of credit takes the place of daily auctions of a large amount of credit at a high stop-out rate. So it's in fact not a standing facility, even despite its name. It's an auction facility. And in fact, it uses the same technique as the term auction facility used to provide credit for most of its life, actually. One question this raises is, why not use Section 1313 authority to authorize the SRF, which is precisely there so that the Fed can lend against Treasury and agency collateral. The objective of the SRF is primarily to give confidence to dealers or large banks that they will have the funding if they need it, so that they are more willing to provide funding in stress, such as during the repo market turmoil in September of 2019. I note that the primary credit can do the same function for banks, but banks aren't willing to use it. Sort of remarkably, when talking to treasurers, the bank treasurers uniformly judged that the standing repo facility would be stigma-free. That was basically because they just viewed it at this point as if you were to use it, it would be a business decision. and they thought it would remain stigma-free as long as borrowing was seen as a business as usual activity. They don't think, however, that it will remain stigma-free if the Fed continues its current policy, which is to tell banks that they are not allowed to assume that they use the SRF in liquidity stress projections. So there's quite a bit of tension there. The Fed wants banks to be able to use this as a normal business facility, but they also say, but you can't use it. You can't assume that you're going to use it when your liquidity is being assessed. So finally, a few words on moral hazard. So of course, one of the main costs of central bank lending that's discussed is moral hazard. If a bank knows it can borrow from the central bank, it may take greater risks than are socially optimal. And there's a couple of main ways that moral hazard has been controlled. One is through liquidity regulations that we've just been discussing. The other way that was popular, especially in Europe, was called constructive ambiguity, which was basically being studiously vague about whether you would or would not provide liquidity support. Now, constructive ambiguity didn't survive the global financial crisis, basically because it was pretty widely concluded that once the financial system becomes weak enough, there's no doubt that the central bank will intervene, and it's just not something that's gotten as much discussion now. But I think a general question that deserves a lot of further consideration is, if the central bank actually reduces liquidity risk, then is it moral hazard if institutions adjust? Is it moral hazard generally if the central bank is providing correctly priced, sort of market priced credit? So the government provides me a safe neighborhood. Is it moral hazard that I walk around unarmed in that neighborhood? Now, moral hazard could be at its greatest when a central bank is lending to an institution because it is too big to fail, or it is known that the central bank will do so. Now, the central bank, under those circumstances, will be under pressure to provide subsidized liquidity support, raising the possibility that indeed that would subsidize the taking of risks by those institutions. Another big question I think we all have to consider is, what is the moral hazard cost of the Fed immediately rolling out all of its global financial crisis lending facilities in response to the COVID-19 crisis? It now feels like the sort of the baseline response of the Fed to a financial crisis is to immediately provide a lot of emergency funding. I do recall, after the global financial crisis, trying to encourage money market reform, talking to people in the money market industry, and the question I was asked back then was, well, why do we need reform when the Fed can always step in and provide liquidity to support money funds? And I think that question is now even more pressing. All right, I'll stop there.
Thank you very much, Bill. And the discussant will be Bill, English.
Oh, I got to stop sharing my screen so Bill can share his. To do that,
All right, Nelson, stop hogging the
I
screen.
need to figure out how to do that. That's interesting.
It's the red button.
Up at the top.
At the top of the
Yes.
sharing screen.
It says stop share.
How about if I killed that? Did that do it?
Yes.
Yes, that did it. Okay.
I think my multi-screen format is messing me up.
Okay, we see your slides.
All right. So thanks very much for that talk, Bill. This is of course an interesting and important topic, and I enjoyed the chapter a lot. I didn't have kind of serious problems with it. I have three things I want to discuss. One is kind of coverage and balance of the chapter. The second is organization, and the third is the figures, or rather lack of figures, in the chapter. So on coverage and balance, I mean, as Brian Madigan and I kind of discussed earlier about our chapter on the Fed balance sheet, all of these topics are very broad. You could write a lot, you could say a lot, and the question is kind of picking the right targets. I thought that 10 pages on the discount window was probably a few pages too much. given that there are only about 2.5 pages on lending to non-banks, and I felt like that was a really interesting topic. There are a number of other interesting topics, but for me, that one is the biggest one. So maybe a bit more on the issues around setting up the facilities, consistent with the Federal Reserve Act. What are those conditions, and how constraining are they? Sometimes you hear people say, gee, the Fed could set up an SPV, they could lend to it, that's lending, and then the SPV could go and buy equities or something. I don't think that's true. I think there really are constraints on what can be done with the money. You have to look through the SPV and focus on what are the ultimate transactions. But thinking about what are the limits, what are the constraints, about just the pricing, winding these things down, these are important questions, and I think it would be useful to explore them. Maybe some discussion about the CARES Act financing of Treasury capital for these programs. So under the post-Dodd-Frank rules, 13.3 loans have to be made with sufficient security to limit the risks to the taxpayer. One way to do that is with Treasury capital. That's what was done with the CARES Act. But how do we feel about that? I mean, how does that fit in with central bank independence, for example? How large a role are we comfortable with the Treasury having in these programs? A second thing that you could do, but I understand there's limited space, is some more history. 13.3 lending came in the Depression. The Fed also got authority to just do lending to businesses in the Depression and did it. There was lending for the war effort during World War II. The Fed actually didn't lose its business lending responsibilities fully until the 1950s. So maybe some discussion there. And looking forward, you could imagine the Fed picking up responsibility for lending for climate issues, for example. And how would we feel about that, and how might that work? Another thing you could do is more international comparisons. The ECB and the BOJ, as we heard earlier, particularly for the BOJ, have much broader powers than the Fed does. And is that good? Is that bad? How should we feel about very broad non-emergency power at the ECB and the BOJ? I remember being somewhat envious of the ECB during the financial crisis, and so some thought on that is useful. There isn't a whole lot on repo. It's just a paragraph in the paper. Bill actually talked about this in his presentation, and I guess I urge you guys to talk more about it in the paper. I think the new repo program is very interesting and is potentially very important. It offers a possible solution to stigma, as Bill said in his remarks, and I think it's worth significant discussion in the paper. As I say at the end here, given length constraints, you can't have everything, but I think some more thought about exactly how you want to allocate your space across these topics would be worthwhile. Organizationally, you have a similar problem to the one we had in our chapter. You have a bunch of history that in some sense is providing examples, and then you have broader conceptual issues that you want to talk about, and how you interleave the history and the conceptual issues is hard. There are a few places where it struck me as maybe not working as well as you'd like. You talk about the current Reg A discount window setup on page 8. You don't get to the 2003 changes that brought it about until page 13. Maybe some reordering would be helpful. The reasons for stigma came towards the end of the section on stigma. I guess I'd put those up front. You have two nice paragraphs on kind of why do people feel this stigma, but I'd use those. I'd have those up front rather than coming kind of late in that piece. And it might be helpful to have more discussion at the beginning about the difference between lending to implement monetary policy and lending to address stresses at firms or in markets. That's a key distinction you make, and it's very clear later on, but maybe setting it up earlier on would be helpful. As for figures, maybe show a quarter system. You talk about it, there's no chart. The borrowing function seemed like it cried out for a chart. Not everybody grew up at the Fed like us and knows what these things look like. So maybe that would be helpful. A table just showing the different amounts of lending at the different central banks. You have a nice discussion of different central banks do different things with lending. The ECB has lots of lending. Just a table or something seems like it would be helpful. Some numbers on the 13.3 programs, maybe. This is all, of course, a matter of taste, but I think it might have been helpful for the reader to have some tables and charts along the way. That's all I've got. Thank you.
Thank you very much, Bill. We have a few minutes for any other questions or comments.
I have a quick one on. I admired the way Bill presented the paper and also had questions to himself on kind of pondering why is it set up this way. In a sense, it's nice to see these as open questions for further research. In another sense, especially given that these are in journal publications, and we asked these people for these chapters for a reason. Having your take on these would be interesting. In particular, why not 1313 for the standing repo facility, right? Because that indeed seems like an obvious thing to do. And in general, we don't think of the U.S. central bankers as dim-witted people. In particular, they have great staff to lean on. So probably someone told them something. But what it might be, in your view, would be an interesting thing. And I'd be interested in your take on this. And indeed, in the other questions you posed later in your talk too.
Oreste, you had a question.
Yes, also a quick comment, a bit echoing what Bill English had mentioned before. So I think I also thought it would be, okay, I only skimmed through the chapter, I must confess, but I also thought it would be useful to have a somewhat broader discussion internationally. One thing that I would also find interesting is your take in, for example, if you wish, the best practice in central bank lending across central banks. So at the moment, you very much directly zoom in on the US experience, and there are, of course, even there many aspects that then would come up. For example, the maturity of central bank lending is something that has also for the ECB has changed a lot over time. But again, I think if in general, all the international experience can give you some view of these best practices, and it will be useful to provide.
Are there any other questions or comments? Okay, Bill, do you want to just take a minute to say something?
Hang on. So there was a comment from Will Roberts in Q&A that says, what should the footprint of the Fed be in the repo market, particularly after the debut of the SRF?
Okay, I'll speak for a few minutes, or a minute,
Yeah.
maybe give Brian a chance, Madigan a chance to speak as well. First of all, Bill, thank you so much for the excellent comments. You really hit on a bunch of things that I know I at least felt like I was struggling with in drafting it. So that was very helpful. More broadly, I'd like to say it seems like there's nothing more appropriate for such a reconvening of monetary affairs than all of us getting together and commenting on each other's work. That's what we do. And thank you, Oreste. That was a great point. I mean, I also think, similar to what you just said, is the issue of why should you lend to broker dealers generally? Should you lend to bank-like entities on a regular basis? That's a pretty key question that Europe, for example, is much differently placed with. Rafet, I'll communicate with you bilaterally on what I think are the answers to some of the questions, but I think that's a great point. I take that on too. Brian, do you want to say anything?
No, nothing else, Bill. Thanks.
Okay, well, thank you very much. That concludes our morning session. The Zoom channel will stay open. So if people want to just chat informally, they're welcome to do so. And we will resume at 12:30 with Eric Swanson talking about the Fed funds market. So see you in half an hour.
And if you want to sign off, you may do so and then re-click the same link